Afternoon, ladies and gents. Trust you well, and Happy New Year to everybody. Hope you had a great Christmas. What I'm going to do on this Facebook Live and podcast, for those of you listening to it on the new podcast, is to set off the new year. I had a conversation with one of my friends the other day, and we were talking about what 2020 actually looks like. And you remember last year we were talking about how volatile everything is. We're in like hugely volatile times where, when you look at like basic economics, a lot of it works on like reflexivity. Like George Soros talks about reflexivity. And this is essentially how quickly the market changes based on the headlines. We're in really volatile times. And I wrote a whole article for January's YPN magazine about the gold rush. And this talks about volatility versus volume. There's a lot of economics in there about the key trigger points for you to look at going into this year. But I actually jotted a few points down. I thought I'd share them on this. Call and on this recording to give you a few sort of sentiments as to where we're going. It's not a full rundown of the economics, the markets, the curves. It's a few headline sentiments for you to tune into, and then I'll do more videos, updates, Facebook Lives as the coming weeks progress. Obviously, there's a lot going on at the minute, and this is just a headline snippet for you for 2020 predictions. So a few things to consider. So the economy as a whole, obviously the economy doesn't matter what industry you're in, property, manufacturing, retail. The economy has a huge play on all of these things at a macro level, and then on a micro level, there's obviously individual market influences that have on the micro economies of those sectors. At a macro level, the things with the economy at the minute is there's a lot of change. So this is one of the things we need to consider. There's a lot of change in the economy. So what you're not going to get is what drives boom times is mass confidence. And the economy really, it's driven by macro factors, government, fiscal policy. It is driven by all of these things. But at the highest level, it's driven by reflexivity. We're all human beings, and we decide to either spend or we decide to save. And this is driven primarily or very heavily by the front page of the paper. If the front page of the paper says property prices are going to double in the next 10 years, every man and his dog, runs out and buys property. When your barber's telling you want to go and buy yourself a buy-to-let property, you know you're in boom times. In times where there's uncertainty, there's change, these things change very frequently. And this is what I'm talking about here is literally on a weekly or monthly basis. So what we're not going to have in 2020 is mass market confidence. We're not going to have any boom time. We're going to have a lot of change, and the confidence levels, like if you look at confidence levels last month, they have increased. So post-election, there was a spike in confidence with things like spending, RPI index, the reports on property transactions levels, confidence levels in listing properties, buying properties, selling properties. There was a spike in that last month, but you're going to see this change very, very frequently. And a good example of this is, so when we talk about the macro level, like 2020 being the gold rush, this is where there's huge opportunity because there's uncertainty, but there's also volume of stock. So landlords are leaving the market, investors are starting to feel the pinch from the tax changes. As of this month, that's going to release a lot of stock. Baby boomers downsizing, reduction in demand, so transaction levels start to drop. You've got people increasing supply because they've got to sell, and a reduction in demand because people don't know whether they want to buy. You've got all of this sort of stuff having an impact. What you're going to see on a weekly and monthly basis over 2020 is this change very frequently. So we had an election, which we didn't anticipate on the last update I did for you. I said that we were going to have an election in 2022, then maybe one in 2020. That was actually obviously pulled forward quicker than anyone was expecting. But it has now given us a real shift it's given us a real shift change in gears, basically. We can start to move forward now, and we know where we're going. If we'd have thrown back into another, two more referendums, another election, gone into all this stuff again, it would have been a lot more uncertainty. So we know the direction of travel now, but what we're not going to get is huge confidence until we hit some real key progress points. So like we've got the actual Brexit, we've got actually leaving Brexit, then we've got our trade deals, which should be done by the end of this year. And what you're going to see on the headlines is a very fluid, volatile story. So for example, if you compare, say, post-election. So week after the election, everything was positive. Britain's going full steam ahead again. We've got confidence, we've got clarity, we've got a political majority. It's all going. All of a sudden, I was thinking, oh my God, like I'm influenced by this stuff as well. I was thinking, this is actually happening. It's all going to be good again. We're going boom time again. And that was 4 weeks ago. You're now into general day to day, and all of a sudden now there's a spin on it because there's pressure on the new government. Boris Johnson's first decision going into power was to take, like a 2-week holiday. So it's like throwing these questions over he had his cape on and he sailed in and he was there with his halo. All of a sudden it's now, right, well, your first decision was to take a 2-week holiday whilst there's obviously international issues going on that need to be dealt with, things like this. There's like controversy thrown in the mix now. So now we've gone from being buzzing high to like neutral medium. Like, is this going to be good? Is it going to be bad? Is he going to deliver? Can he pull through on this? There's lots of he's got Brexit to deal with. We've got the UK economy. We've got the National Health Service. We've got this infrastructure spending that's starting to come in, which will create work and jobs and growth. But now we've got obviously international friction, which needs to be dealt with in different capacities. There's all this stuff going on, which is going to have an impact on reflexivity as to what the market does. So we need to track it pretty consistently. Best case scenario, we see reduction in property prices, we see deals, we see reduction in demand, things like that. Worst case scenario, we're going to see stability. And what this is going to be is a period of stability through 2020, which is where you get on board here and then you ride the wave when it comes again. So there's certain ways you can capitalise on this. I'm going to share this on this recording. There's certain ways you can capitalise on this in 2020. Even if property prices don't go down and we don't get an immediate discount today, which I think there is an opportunity to do that. In fact, we've just put an offer in this morning, so second day back, just put an offer in this morning on a new development site. Without a doubt, it's one of the best offers we've put in, or one of the best sites and value for money we've seen for probably 2 or 3 months. So there is stock coming to the market. There is motivated sales. Money talks, if you're a cash offer, this is a development site and you're buying unconditionally, you're taking the risk, there's extra margins there you can take on. There's definitely deals to be done. So 2020 is going to be a time for opportunity. It's going to be a time for growth. You're going to have to understand how to manage your risk profile. You're going to have to understand the game you want to play, and you're going to have to be quite strategic. But now is the time to observe the masses and do the opposite. While everyone's sitting on the fence, uncertain, it is definitely a time to move forward. So economically, there's lots of change, volatility. That's going to change a lot. I don't think we're going to see a huge amount of growth. If you look at different forecast reports for like UK, USA, different economies, like UK at the minute, if we get 1% GDP growth this year, I think we'll be doing quite well. If we stabilise and don't see any huge dips because of things like manufacturing, issues getting materials into the country, I think we're going to see stable, like GDP. I don't think we're going to see rapid growth. If we see 1%, I think we'll be doing quite well. Interest rates economically, I don't think you're going to see them go north unless we see some sort of hyperinflation where the trade barriers go up, we have trouble importing goods, there becomes a shift in the demand and supply mechanism of basic basket goods, your RPI index, your food, consumables. Unless we see a huge spike in price on those where hyperinflation and interest rates are used to pull that inflation down, I don't think we're going to see a rise in interest rates. In fact, for those of you that watched my predictions last year, 8 of the 10 predictions that I made were accurate, and the other 2 were around economy, which were just delayed because of Brexit. Last year I said about interest rates are just the fly in the ointment. You don't even need to worry about them. My sentiment's very similar this year. Interest rates are unlikely to move this year north. You may, I think, like obviously this is changing on a weekly and monthly basis. Based on the way things are at the minute, I think if we don't see a hyperinflation, you're more likely to see a reduction in interest rates to stimulate spending than you are an increase in interest rates to encourage saving. I think as it stands, interest rates aren't going to go up. If anything, they may potentially go down, which, they may go down. We'll see. I don't think you're going to see them go up. And if they do go up, they're not going to have an impact on what you're currently doing. Employment rates, we've got record low unemployment rates. I think that's going to maintain. It is starting to drop off. It is starting to slow down. We've got the lowest unemployment rate in like 40 years. Best income levels in like a decade. I think that's going to maintain. It is starting to slow down, and the first sector of that that's going to be hit is going to be like your last in, first out. It'll be your 18 to 24s, your younger generation moving into work. The supply of those jobs in some capacities may be the first ones that are hit. I don't think it's going to have a huge impact. I think keep an eye on it. And if you are looking to recruit, you might be able to get some great value for money in that space, the younger employment market. And then economically, property prices, I think, will be stable at best. I think in some areas they'll reduce. You may see marginal increases in very high demand areas. That's always the case. At a macro level, I think property price is going to stabilise and just remain stable. There could be an opportunity for them. There could be an opportunity to where supply exceeds demand, which is likely. Where supply actually increases, demand reduces, and we actually see a reduction in price in some areas. That's the macroeconomics of it. I think property prices, if you're looking for boom times, it's going to be stable at best in the residential space, the PRS. That said, I think the investment market is going to remain active and potentially increase in activity. The demand for investments for people who've got liquid capital, the more uncertainty we have, the longer these low interest rates stay down, the more volatile other asset classes become. You've seen people cashing in their real estate portfolios, their commercial portfolios. A lot of the big boys who land bank are starting to liquidate funds. There's a lot of cash going to be sitting around that needs to be allocated. Whilst the residential market is likely to stabilise at best, it may even go down, which would be good for those. Don't worry about property price. Don't worry about not buying because prices might go down. If they go down, you buy more. It's using the model of cost price averaging for those of you that pound cost averaging. So if it goes down, you buy more and you ride the long term pound cost averaging, the long term curve of that. The investment market is still active, and I think those that can offer secure income, fixed secured returns, investment blocks, pension funds, the bigger stuff that has lower yields but secure income, so not your service accommodation, individual units or your HMOs, more like your hotels, your blocks of build to rent, your high density, high yield developments, anything that's got security of tenure and stable income. The investment market for those assets will go up. So what you'll see there is a compression in the yields where investors will take a lower yield for purchases. Finance. So there's a few snapshot of the economy. That's the main thing that's going to play into that this year is seeing what plays out there. On a more local level, or a more sort of closer to home level, thinking about finance, I think what you're going to see is, and I've got a gut feeling about this, and economically there's very little to back it up. I think that in 2020 we're going to see the traditional banks and lenders lock up. So I think what's going to happen is traditional lenders, buy-to-let lenders, the mainstream banks, as interest rates are low, may even reduce, but also lending rates now. If you look at the lending rates actually reducing because some of the banks have come into more liquidity and they need to get money out the door. They're starting to take higher risks. They're going into higher loan to values. If you look at those, they're offering increasingly reduced rates for your resi products, your buy-to-let products. I think, and again, I have no real solid economic facts to back this up, other than a gut instinct of all the things that I read, study, know about the market. I think the finance market may lock up this year. I think the banks, the buy-to-let space may become very difficult to lend. I think the criteria will increase, valuations will become more challenging, for want of a better word. The valuers won't want to put their head on the block. I think there'll be a lot of challenge in getting money out of those traditional buy-to-let lenders. Equally, I think there'll be funds that are available cheaply. I think this will be in a couple of spaces. I think if you go to more like your challenger banks, although you need to be careful of those, if you look at the signal of some of the early banks, you've got your challenger banks, like your metros and people like that who've got an appetite, they've got funds, but they are starting to come into some troubled water as the economics and the confidence levels start to slow down. These people start to take more impact into what they're doing. The challenger banks some of them are starting to come under more pressure. Metro have had a few challenges that many of you will be aware of. You've now got the new curve of mainly either e-licensed banks or the app-based banks. They're definitely taking market share now for handling transactions because they're easier to use, quick opening banks, free account to account, similar platform transfers. that space is definitely accelerating, but you need to look at the commercial fundamentals that are underwriting this. If you look at, are these banks actually making money? You know, they're holding strong balance sheet valuations, you know, in the tens or even hundreds of millions, but their revenues are down in the millions, the tens of millions. Or I think I saw one the other day which was like, it was ridiculously low. Be very careful in the finance space, and just be savvy with what you're doing and the people that you're working with. The commercial lenders, the big boys, the established players that do your portfolio deals, like your Lloyds, there's a couple of other players coming into the market in that space as well. I think they'll be consistently stable. I think they'll want a good collateral on the portfolio. They want to see good serviceability. Although Lloyds, when we started working with them in 2011, 2012, we're wanting a coverage of like 190%. That's come right down now to like 110, 115%. If you've got for our portfolio, if you've got a good portfolio with equity, you're moving all of your cash flow each month through the Lloyds account. Lenders like that will remain stable. They won't be the cheapest. They can take a long time, but you'll get good valuations. You'll get good leverage. The finance will be available. They won't really mess you about. They might drag it out a bit. That space will be quite active. Crowdfunding. I think crowdfunding has had a clear run. I've said this a million times over the last few years. Crowdfunding, we will look back on crowdfunding in the next 3, 5, 10 years as we do now, the 125% mortgage. It's bonkers how the crowdfunding market is working. It's liquid, it's easy access, it's unregulated, it's an amazing space to borrow money. So it's an amazing space to borrow money. Is it an amazing space to lend money? It depends on what your security is. So we've seen some of the crowdfunding platforms go bust. We saw a couple of those last year. Equally, we've seen a number of them absolutely boom, and for very good reason. Look at the security that's available, but crowdfunding is still a we're buying a new business at the minute. So we're making our first acquisition of the year this month, and of another business, and we're using crowdfunding for that. 100% crowdfunding, blended rate 8%, no entry or exit fee, early repayment. It's a really, really good place to be. Very easy access capital. That said, I think what you're going to see over the next 12 months, and this is my prediction for the finance, is that crowdfunding is going to start to experience bumps in the road. You're going to start to see some more deals go south. You're going to see issues with lenders repaying funds. You're going to see deals, conversion and success rates start to become more public. And as these loan terms come to a close or come to a repayment period, I'm talking about the mass market here. There's some crowd property platforms, specifically in property, that use first charge lending. They're secure. There's other platforms that are becoming more challenging. The space, I think, is very, very effective. I think it's a great place to be, and I'd encourage you to make the most of it. I think what's going to happen this year is we're going to start to see emerging signs of regulation, rules, criteria, restrictions, and it's going to become harder and harder, like traditional lending, as you'd expect. So the crowdfunding, peer-to-peer space, I think that's going to be very active, and I think it's the beginning of the end for it being a gold rush. I think you're going to see more like regulation, things like that. Make the most of it while it lasts. I think you're going to miss that in the next couple of years as it starts to become harder. We'll look back and say, we applied for £300,000 loan on crowdfunding and it was there in 3 days. We're going to look back on that in a couple of years' time and think it's absolutely bonkers. It's going to become harder space for some platforms, especially if it's not asset backed. If it's backed by personal guarantees or no guarantees, they're going to become less liquid. My advice to you in the finance space would be to get liquid. We're very liquid at the moment. Everything we're buying is cash. We're developing cash, and then we're exiting to the investment market. So our high density developments, we're buying them cash, developing cash, renting them out, build to rent to sell, renting them out, holding them for a strong yield, which is very, very high on the total spend, and then putting on the market at a compressed yield so that if they cash flow, happy days, we'll hold them, they work well. If they sell at the top of the market, like the first couple, first one has this year, if they sell at the top of the market, then the capital exit is 10 years profit, cash that in, roll it onto the next one. It really is having your cake and eating it. I'll do some more videos this year on high density developments. Rental market, so a few little sentiments to finish. Rental market, Private rental sector will continue to grow, like it will boom. Growing population, increasing pressure on the private rented sector, traditional landlords. Supply is going to stabilise, probably reduce. Demand's going to continue to grow. Access over ownership is the new shift of the millennials. You know, there's increasing demand per head, growing population. All of this points towards an increasingly high demand private rented sector in the mass market. Of course, in every niche and strategy, that's going to be different. Mass market, PRS will continue to boom. Rents will continue to increase. Affordability issues, like make sure you've got your, when you have your affordability checks for your tenants, make sure you've got that, and then ideally backed up with a good security bond, a deposit, or ideally or a guarantor, because affordability, as that starts to become stretched, will create issues in like arrears, rent chasing, things like that. Investment and development, I think there's big opportunity in certain spaces. Again, I'll share this with you during the year as it plays out. But as far as investment goes, planning gain, buying stuff unconditionally, high density, emerging permitted development, lots of the new, those of you that have looked at the new permitted development that's come out in the last 6 to 12 months and the emerging permitted development that's looking to come on, if you're buying speculatively and you know how to use these mechanisms, you know where they're being encouraged until they flick the switch, that space is going to be very, very active, like very lucrative for those of you that get it right. Investment and development, construction costs, I think will stabilise, potentially even decrease. Construction levels have dropped to the lowest point in a decade. The big boys are starting to slow down to a capacity. I think the supply of, maybe not materials because of Brexit, but I think the supply of labour will increase, or rather the demand will decrease. I think the prices will level out a bit because they've become quite challenging over the last couple of years for the construction costs. In areas where you can buy cheaper than you can build, even if prices don't go down, where you can buy houses cheaper than you can build them, and you can rent them for a strong yield, you need to make sure you're aware of your exit market, and you need to make sure that you're not in a saturated market, which is pulling the price down to an excess in supply. If you can find those places where the asset class is cheaper to buy than it is to build, as a long-term pension fund investment, that's a no-brainer, because even in line with inflation, the cost of producing those assets, especially if they're near areas that are going to get released for planning, development, things like that, outskirts of city centres, near to ring roads, city centre sites where you've got big development areas that have been sat for years waiting for somebody to get an appetite, those sort of spaces are going to be very, very lucrative. And single-let properties. I mean, our big focus this year, we're moving a lot of, or I personally am moving a lot of my activity and capital out of the larger developments, out of our HMO portfolio, and just into low yield, long-term, vanilla, buy-to-let, single-lets, flats, creating the equity so it's good for the balance sheet, and then looking for a modest yield, return on investment between 20 and 40% once you've re-leveraged out, so buy cash, refurb, refinance out, leave a minimum 20% equity in, and then aim for like 20 to 40% return on cash that's left in. You know, you have got a 6 to 12 month void period of your capital while it's in there, but that's replaced on the balance sheet by the capital gain. That works really, really well. And, you know, HMOs, rent-to-rent, service accommodation, these high cash flow, noisy assets are absolutely what you need for cash flow. When you need cash flow, money in the bank, get yourself going, first move into property, they're the only way you're going to replace your salary quickly. When you get to a position where your cash flow is established, you're making profit, you've got liquid investments, my attitude is to then move it into assets. You've got cash flow, profit and assets, move it into your asset classes. This is high density, this is your blocks of flats, single let, like blocks of flats, not individual flats, single let properties, you know, the very easy assets, but just get some equity in there and hold it for the long term. That's the sort of investment development space where I'd recommend considering this year. Big wins, so the places, so just to finish, the big wins you're going to see this year. Build to rent, still, I've been backing it for a couple of years. Build to rent, and if you do build to rent to sell when you're selling onto a fund, that curve, the build to rent curve, is going to follow exactly the same curve as PBSA, as student accommodation has. Purpose-built student accommodation has been around for like 5-10 years now. You know, it's definitely top of the growth. It depends where you are in the UK, but as a strategy on the macroeconomics, it's well into growth, heading towards maturity now. the people who operate in that space there are like your REITs, your pension funds, the compressed yields that you're exiting to, and the main margin there when you get to that space is actually in the land and in the planning. Excuse me. What you're going to see with build to rent over the next few years, as it becomes an established asset class where you've got 3-5 years more proven income, proven yield, proven returns. When you've got that under your belt and you've got that sort of proof of concept, the funds will then start getting involved quite aggressively. At the minute, they're involved. Your first mover advantage is getting in. Your legal and generals are coming into, build to rent, specifically modular housing, prefabs. They're getting involved, but it doesn't have the real solid proof of concept of these long-term rental returns yet. Once we've got that and there's an established management structure in place, the build to rent space will become far more active. At the minute, I still back it as one of the best strategies to be doing. Build to rent for us, it's build to rent to sell, having your cake and eating it basically. If you want the cherry on top, build to rent to sell, or build to rent, or build to rent to sell, or build to order in the public sector, care, extra care, over 50s, care villages. All of this emerging space is where it's at. Like, it really is. We're starting to move into this a tiny bit, like literally testing up. I've always said, if we were starting again now, I'd be going into care and extra care. Starting initially with your purpose-built schemes or your conversions, then, well, probably your purpose-built schemes, probably leasing or partnering with an operator, being the deal sourcer, the planner, the developer and the main contractor, developing that and then leasing on to care providers. The care space, if you look at the economics, is absolutely flawless. Baby boomers are turning 70. They've got all the capital. They've got all the wealth. The care sector as a whole has been a downward moving space for a long time, like increasing regulation, increasing operating costs, a reduction in local funding, national funding. It's a very defragmented space. It needs a new curve to come through. Purpose-built care, extra care, anything to do with charities, homelessness, the social space, it's not found itself yet. So there's a lot of opportunity there for the year ahead. Businesses in property. So property investments, development's cool. The real win this year is going to be building your business over the top, whether it's a construction company, or maybe not a construction company, but a deal sourcing company, a portfolio management company, a service accommodation management company, a service-based company, a consultancy company, a company over the top of your portfolio, like building proper businesses. There's so many opportunities out there at the minute that are going to disappear. Having a proper business in property will be a game changer for you in 2020. And a good thing here is if you don't want first mover advantage, don't want to take the high risks and go for those highest returns, sail the tailcoats of those who do. So where you're seeing these waves come in, like modular housing or build to rent or serviced accommodation, or where these industries are really growing, look at what curve you can ride that follows onto it. So you don't take the risk, you provide the supply chain, the services for the companies that are making it, like service accommodation, a service accommodation management company. There is one big player in the service accommodation management space, but that service is currently a bottleneck in a lot of areas to stop independents go into that space, because at the minute it's business owner operators. When third parties want to come in as investors, one of the bottlenecks there is to have real reliable operators in certain areas. We did it with Multi-Let UK. When we followed that curve, the demand exceeded supply. Everyone wanted HMOs, but nobody wanted to manage them. We created the UK's largest network of HMO management portfolio companies, HMO portfolio management companies. That rode that wave really, really nicely. The next curve would be something like a service accommodation management company. If nobody's doing it in your area, there'll be investors that want to get into that space like me. If you can see that investment class works, we've got a development site that we're considering doing service accommodation with now, but we don't do service accommodation. We don't want to do it. We want to give it to an agent or lease it to somebody who does know what they're doing. That's the sort of space that we'd operate in that capacity. Ride the tailcoats, ride the wave like that. PBPA is going to be big. So I'm not talking specifically now, although you're going to see the green shoots in 2020. So PBSA is purpose-built student accommodation. What we've started to term PBPA is purpose-built professional accommodation. The closest you've seen to this so far is like co-living. Big, and I'm not talking about nice HMOs, I'm talking about purpose-built blocks of cluster flats or micro studios with commercial downstairs, restaurants, libraries. this new space, which is now standard for the student curve. If you follow the professional curve, it's absolutely identical as the student curve was. Follow the economics of that. You're going to see that with purpose-built purpose-built professional accommodation. Keep your eyes out in your area and look for the first purpose-built block of flats that's gone up, that's got a gym, or it's without deposits, or it's all-inclusive bills. These frictionless type of asset class, that's going to be big over the coming years. In your area, I think you'll probably see the first operators of that in some capacities. We've been doing that on a micro scale in certain capacities for the last couple of years, testing it. There's definitely a much bigger market which is going to capitalise. It's not a game that we're playing, but it's a game you're going to see in your area. And then finally, other big winners is going to be niche service accommodation. Niche service accommodation. So service accommodation, a flat in a block of 200 on a rent-to-rent. In the boom times, that's good. Happy days, easy money, low barriers to entry, fill your boots, milk that cow for as long as it lasts. Just make sure you can get off the wave before it hits the beach. Niche service accommodation is going to be more sustainable. And this is things like country cabins, narrowboats, yurts, small construction on agricultural sites, tree houses in the woods. These service accommodations weekends away, which aren't as expensive as a holiday, and are more accessible financially and online than any of the alternatives. These niche, high-priced, low-cost to build, develop, put in place niche opportunities are going to be booming. If you look at the demand for those, it's very high. If you look at the price points for those, it's equally very high. If you look at the supply, it's modest. Most of those are oversubscribed. I think the niche space of service accommodation will also be a big win for 2020. Big losers for 2020. Just to finish, tax changes not incorporated. If you've still got property in your name, like single-let residential property, HMOs, whatever, in your name that you're renting out, unless you've found a legitimate workaround, that is going to be a big loss this year. The full impact of tax changes coming in is absolutely crippling. It is absolutely crippling. You need to incorporate, we did all of ours, pretty much all of ours, through an LLP, 2 years in an LLP and then incorporated. The people in the market who haven't done that are going to feel the pinch this year. Other big losers this year, the industry is going to continue to move. Don't underestimate, it's going to continue to move from cottage to corporate. So cottage industry, where we're all friends, it's a bit of fun. You can rent it out to tenants. Don't worry too much. It's easy money. It's just we'll do the tax return at the end of the year. We'll pop round and do the maintenance, when they tell us. The industry, that traditional cottage landlord industry, is going to continue to disappear. And the shift that I talked about 2 years ago, cottage to corporate, is going to continue to move that way. If you're not up to speed with regulation, if you're not up to speed with licensing, if you've got rooms that are too small to rent, if you are pushing the boundary on EPCs, things like that, you're going to start to lose. They're not going to start to let up. They want their pound of flesh. The government, the local councils, they're starting to realise they can make money now. Selective licences, additional licensing, HMO licensing, rental licensing, changing criteria, qualifications, all of this is going to continue. Professionalise your business. If you're not doing that, you're going to get caught short. You're going to catch out. Other losers this year are going to be people who are trying to catch a falling knife. So if you're on a curve and you've ridden the curve for years, you know the industry, you know everybody in your market, it used to do really well, it was easy money, it's starting to get harder, it's starting to get more challenging. It's because the market has progressed, it's matured, it always does. It's getting to the top of the growth curve, the maturity point. You need to make a strategic decision here and make sure you really understand your market, not just think you understand it, not just think. What you don't want to do here is catch a falling knife. If the market's on its way down, it's inevitably going to go down. Today is the best day it's going to be. It's only going to get worse. If you're struggling to make money now, it's going to get worse and it's going to actually start costing you money unless you reposition it, re-strategize, restructure the portfolio. The big losers this year will be those who are trying to catch a falling knife. Somebody asked me years ago when I was speaking at an event, am I scared the HMO market will change? And I was like, no, I'm not scared it's going to change because I know it will change. everything changes. If it's good today, it will be bad at some point. If it's bad today, it will be good at some point. You need to understand where you are on the curve. And if you're on the end of a curve, you've milked the cow for long enough, maybe it's time to actually sell, re-strategize, restructure your portfolio. Those that are holding their breath, those that are trying to catch a falling knife, those that are chasing something that's on its way out anyway, will be losers in 2020. There's nothing wrong with jumping ship. Look at the market you're on, like letting agencies. The industry's become so difficult now. Regulation, EPCs, landlord taxation, removing application fees, revenues have dropped, costs have increased. If you're in that space now where it doesn't make money, you've got two real options. You've got to sell while it's still worth something, or scale so that it's worth something. It's hell yes or hell no with like letting agencies. In the middle is just hell. It's like, don't try and catch a falling knife. You can only hold your breath for so long. There's nothing wrong with getting off the bus and changing strategy. The people who try and catch a falling knife in 2020 are going to catch a cold. And then my final one, and I say this very carefully because it's not going to cause any grave danger or issues this year on a macro level, but you're going to start to see it. But the footnote to this is I have been saying this since 2012, so take everything I say with a pinch of salt. Another area which I think you're going to start to see hit maturity and potentially decline will be purpose-built student accommodation. In some cities, the market plus the developments plus the pipeline has got to be well into the maturity phase and approach saturation. And the reality is, it's so hot, and this is in developed areas. Ones that I'm closest to and aware of and familiar with is Nottingham. So Nottingham is very developed. It's very mature. There's stock going up left, right and centre. The council have acknowledged that you would think it's going to hit supply. However, it would appear economically that there is still demand for this stock. I personally think it's a dangerous game to play. I think that curve is very well established now. In some cities, you've got your first purpose-built student accommodation going up, and the biggest impact that's going to have for you for the next few years is it'll impact the HMO market. Those of you that are familiar with the purpose-built student accommodation market and you're seeing it go up everywhere, when it starts to hit maturity, supply exceeds demand, and then what happens is you go into a bit of a price war. Don't buy those units cash, the individual units, because in the boom times, it's giving you 8% yield, happy days, might be guaranteed for 3 years, that's great. But as soon as the rent decreases, the commercial valuation reduces, and then you're in competition with 100 other or 200 or 500 other people who own these units that are not mortgageable, the yield's now compressed, and the only way you'll get out of that stock is reducing price. The danger as well is as you get, when I'm talking about build to rent, you go up the curve. When you get higher up the curve, there's more market confidence. There's established track record. There's proof of concept. The big funds get involved. What's happening here now in town city centres, lots of them, student accommodation, purpose-built student accommodation is the only game in town. And what that means is it's such established market, there's such established track record. You can now go in with bold offers, prime locations, big spec, primary price points, and these guys are going to work. But then what will happen in the same way that when you get studentification, take the cycle back 15, 20 years, where the universities are encouraging investment, HMOs everywhere, what will happen is it'll be location, and price. It'll be a mix. And what will happen is the ones furthest out will get impacted first. So what was first the first mover advantage, hopefully they've now sold out to the funds, because as the big developers come in, the yields have got compressed, the exit market's secured with either a lease to the uni, an exit to a fund. You can go in with absolute confidence as a developer to get in on a small yield because you've got the confidence of the exit. The outside market is going to get really heavily impacted. And you're going to see this, you're going to start to see this in very developed cities through 2020, or you're going to see the early signs of it. It's my final prediction, and bear in mind I have been saying this for years, so do take it with a footnote of that. However, I'm watching the economics, I'm reading the reports, I'm looking at the demand and supply analysis, I'm looking at the price points of these units, I'm looking at the occupancy rate of some of the newest developments that are going up, and I'm looking at the occupancy rate of some of the sites that are outside of town and the room rates that they're actually now getting for those units. Honestly, economically, I think that curve in the most developed cities is now well up at the top of growth, heading into maturity, with the pipeline that's coming probably already at maturity. And I'd say through 2020, start to watch out for that hitting saturation. So if you're involved in that market, you're playing that game, you're watching how the market's working, I'd say keep your eyes peeled on that. Equally, the upshot of that is that curve is very, very predictable. It happens in every city that we've got offices in. It's happened on it's happened in every different council that we've watched at, we've looked. It's happened to all of the HMO curve, the student HMO curve. It's happened to the professional curve. And the way to come into that is with build to rent, is understand what the product the market's requiring and ride that curve in through 2020, get the early adopter curve, get the high yield on the rental hold, and then hold it for long enough to get your exit at the top of the growth curve into maturity, which is, we did a similar thing with our HMO portfolio in quite a mature market, and then exited at the top end of the commercial valuation, having rode it from proof of concept, aggressive growth, into sort of market confidence, maturity, and then saturation. That was far more than I was expecting. That was supposed to be like a 15-20 minute session on 2020 predictions. I hope you got a lot of value from that. Lots of comments and questions. Tony, just to answer yours to close, I have actually got to go now. I'm off to Birmingham, getting ready for Property Entrepreneur for the week. Tony's asking, where would my money go now? So my money is now going into single lets. So I've covered my cash flow. Our businesses are profitable. They're secure. The salaries are paid. They're generating good money. We don't need to squeeze the pips anymore and go for like absolute maximum yields. I'm quite comfortable now moving my money into lower yielding assets, like single lets, blocks of flats, things like that, where it's easier money. You can't do that, unless you've got another income. Until you've got a solid income, you can't do that. But we're at the point now that that's where my money's going. If I was starting again today, I don't know how you test the water. You'd probably want to be a developer or do a joint venture with somebody in the care space, probably an operator. If I was starting again today and or the next waves that we're looking at, I would be looking at care, extra care, build to rent, that space. Because have a look at the economics. Like, you spend two hours reading the macroeconomics of the care space, the demand for the space. I mean, when you've got people like Virgin going into the space, they've got their first sort of purpose-built care centres going up and running. I think that space, the macroeconomics, I think are flawless. I think you can build them in non-prime locations. You can build them out of town, so you can get your land cheap. I think you'll get relaxed planning rules because there's a huge appetite and pressure on the local councils to provide social housing, care, supported living, all of this stuff. The economics for it are perfect. I don't want to speak too soon. We're testing that at the minute. Like, we're testing it and trialing it in some capacities, but on a very micro scale. My money, if I was starting again now, would be to go into that space. Ladies and gents, I've literally got to go and get in the car. So I wish you all a happy new year. Look forward to working with you all through 2020. Property Entrepreneurs, I will see you Wednesday, Thursday, Friday at the Belfry for your 2020 strategy days. It's time to go big, go hard or go home. 2020 is here, and hopefully these predictions gave you some value to go into the year ahead. I wish you all the best of luck, and I'll catch you on the next session. Take care.